Good morning. This is Jim Colburn of Commodity Research Group. I'm here with Andy Lebow, also of Commodity Research Group, and we're here to talk about energy markets. To learn more about us, you can check out our website, commodityresearchgroup.com, where we post our podcasts and our blog. We'd like to thank our friends at EKT Interactive Oil and Gas Training for hosting this podcast. Check out their newsletters, podcasts, and learning modules at ektinteractive.com. This podcast should be construed as market commentary, merely observing economic, political, and market conditions, and is not intended to refer to or endorse any particular trading system, strategy, or recommendation. We are not responsible for trading decisions taken by anyone. Information is not guaranteed to be accurate. This is not an offer to buy or sell any derivative. Today is September 7th. And Andy, let's get started. You had, last time we talked, or I should say we had a podcast, you put out the possibility that the market could actually go lower when there was a lot of very many bullish scenarios put out there. And why don't you talk about what and the market has actually come much lower. What's going on to bring it so low, and maybe talk about what you were thinking back then.
Okay, good morning, Jim. Yeah, we didn't share a lot of the views that the market was going to be unbelievably tight in the third quarter and heading into early fourth quarter. And basically, Jim, it was, we just did our homework really and looked at the balances, and they didn't look that bullish. A big factor, just looking at third quarter, what we had was actually a surplus of about 1 million barrels a day, and then you had to add in, up to 700,000 or 800,000 barrels a day of SPR supply that was hitting the market. So, to us, we saw upwards of 1.5 to 2 million barrels a day surplus for third quarter. And then looking at the fourth quarter, at least for October and November, our total surplus was closer to about 1 million barrels a day. The SPR is going to the big SPR releases from the U.S. are going to stop in October, end of October. But nevertheless, looking at what was going on, both basic supply and demand, it didn't, to us, we weren't seeing the shortfalls. And as a result, I think we were by and large more bearish than what the rest of the market was looking at.
So maybe we can dig down a little bit and start off with demand was underwhelming. And why don't we start with China? What can you tell us about Chinese demand currently and going forward?
Well, China's demand is coming in soft. The zero COVID policy has definitely taken away from where demand is. They're going to end up the year at down for the year at best. At best, they're going to be unchanged at best. But I think when the year is over, year to year, they're going to be down. Now, what the market was looking for, if you go back to last year's expectations, the market expectations were for China to grow by up to 1 million barrels a day, and that clearly is not happening. So relative to expectations, that's a big loss in demand. The other big consumer that is not coming through at all is the U.S. Our numbers have been coming in soft here in the third quarter for a lot of reasons. Chiefly, it's gasoline demand. June was revised upwards, and maybe gasoline demand, and we'll talk more about that later in the podcast. But this driving season has been a bust, Jim. So you've got U.S. and China, the two biggest consumers, with demand coming in soft for again a variety of reasons. COVID, higher interest rate, expectations for an economic slowdown, and high prices here in the US, crushed gasoline demand. So, we've been marking demand down, and we have it for the second half of 2022. Right now, we actually have it up by like a pathetic 200,000 barrels a day. And I wouldn't be surprised as we move later in the year, that CRG revises that downwards by, it comes in unchanged to below last year's levels.
And on the supply side, we just had recent news, OPEC plus going to reduce production by 100,000 barrels. What's the implication of that?
Well, that has virtually no implication. I think that was more symbolic than anything else. They just put out last month in August. They put out 29.6 million barrels a day, which was the most since they were really cranking it out during the price war of April 2020, and OPEC production since the fourth quarter of 2021 is up. It's up almost 2 million barrels a day. So they've been increasing production. Drumbeat increase every month, and this last decrease. I don't think 100,000 barrels a day is, as I said, is symbolic. The big thing with OPEC is that the reason they were able to crank up production to 29.6 million barrels a day is Libya. Libya's production last quarter was down to zero point 0.6 million barrels per day as they had, continuing conflict, which has been going on for years and years now, continuing conflict between the Eastern governments and the Western governments, which has from time to time impacted their production dramatically. Well, they came to a quote unquote truce, which would enable production to increase and last month they were up by point 500,000 barrels a
Mm,
day. That's a huge number,
it is.
particularly for Europe. All those barrels are going right to Europe. I mean,
Right.
Italy is a big consumer for Libya. So I should say all those barrels, but a majority of those barrels are going right to Italy. So that's a that's a big number, and yet another bearish factor for the market.
So you didn't talk about diesel demand when we were talking. I mean, that's what's going on with, was that affected by high prices as like gasoline? Is it being affected by the economy? What's going on there? Stock.
It's pretty interesting, Jim. The diesel demand, I guess, it's been steady, better. It's coming in lower than expectations, but it's not terrible. I mean, it's actually pretty good. At least U.S. diesel demand. European diesel demand is slacker. If
Right.
that's the way, I'm a slacker,
Right.
right? Well,
Yeah.
the European diesel demand is softer. I should say
Yeah.
than like
Yeah.
US, but we've been hanging in at like 3.7 to 3.8 million barrels a day, and I would have thought it would be much lower than that. And perhaps in the fourth quarter, as if things do slow up, we'll start seeing diesel demand soften because that's basically most affected by economic conditions. So I would expect that we'll start seeing diesel demand a little bit softer. But I'd say that's a big plus. And what's really been a big plus for diesel, at least for U.S. diesel, has been export demand. There has been good export demand to some to Europe, some to South America, some to Canada, but we're running well ahead of last year's numbers on export demand.
So let's, sorry, I'm bouncing around with it's kind of market it is, but so the big wild card is what's Russian oil going to look like on the market going forward with the EU sanctions expected to take place December 5th. Can you kind of retrace what's been going on with Russian supplies that have been able to, at first were down sharply, then have come back strong, and where you expect them to be going forward?
Yeah, I think where the market, at least relative to expectations, where the market got it wrong was on Russia's ability to export. You remember in during the spring, the IEA was saying Russian production could be down by 3 million barrels a day. And you know what? Most of the banks were around two, 2 to 3. So let's say the market expectations were that Russian exports would be down, let's say 2.5 million barrels a day in the, during Q2, Q3, in that period. But in actuality, in Q2, they were only down by 300 to 400,000 barrels a day, and in Q3, they're probably down by like 600,000 barrels a day, or just a fraction of what the market had expected, which of course has been another bearish factor in the market is Russia's ability to export. Now, how did they do it? Well, they changed their markets. They moved India was taking zero Russian, and now we're taking up to 1 million barrels a day. Now, why are they doing that? Well, there's been a huge discount. It's 20 to 30 dollars a barrel discounted on Russian crude. China's been taking more, and EU is still taking. I mean, they're taking in July. EU took 1.7 million barrels a day of crude and 1.1 million barrels a day of products, according to the IEA, and they're so that's 2.8. In January, they took 3.8. So they've lost 1 million, but they haven't lost all of it. So Russia's been able to export. Now, the big question is what is going to happen with the embargo? And Jim, I know you and I have been back and forth on on price caps and price controls, and
Yeah,
e-
I, I was going to say I remember an economist talking about Richard Nixon, and he said he shouldn't have been impeached for, maybe he shouldn't have been impeached for the Watergate cover up, but he definitely should have been impeached for wage and price controls. So because they didn't work, and I was just wondering, I'm not sure what the mechanism is, but Russian oil is already discounted heavily to the rest of the world barrels. That's correct, right?
right.
So the spreads around, is it 20, $25 below Brent? Is that the way
Yeah,
it's
that's
worked?
a moving target, but let's say 20 to 30,
20 to 30
20,
below. So
20 to 30 below. Yeah.
so you already have a discount in place. It's good. As hard as it is to keep Russian barrels from flowing to, it's always in the interest of somebody to, try to get outside the embargo. And, I'm not sure it'll be an easy thing to implement, a price ceiling, but, so what's your number basically on how much this embargo will restrict oil exports from Russia, or do you have one?
I don't really have um, there's still going to be pipeline exports coming in. The embargo is for EU, all seaborne exports, which in July was about 1.1 million barrels a day. Let's say 1 million barrels a day. The big unknown, I guess, is going to be on insurance, because the embargo doesn't allow the Western insurance companies to insure the seaborne exports, and something like 80 to 90% of all these seaborne exports are insured by the West. It doesn't mean, however, that other countries, that there can't be insurance, self-insurance from China or India or something else is worked out. The key thing is that China and India, who have been taking much of the Russian exports. They're not part of this embargo. And on the price cap, I'm not exactly sure how that's going to work. I
Yeah.
think they're looking at a a fixed differential to Brent or who, I'm sure they're going to work out some kind of formula. They're talking about the marginal cost of production. I think it's clear there've been a lot of academics and economists working on this, Jim. you know,
Yep.
as soon as you get into marginal cost of production, you know,
Yeah, I know. And
right?
I guess my feeling is that, a lot of these things, those barrels will find they may not go to Europe. They'll just rearrange the trading routes. It'll be less efficient, but the barrels will get out there. And as far as a supply demand balance for the world, it may be short term problems, but once they get them figured out, you know, just like it's already happening. I don't know if China and India can take more barrels of discounted Russian oil. I guess it depends on their demand structure. But is there a problem with the refineries? Can they take this kind of oil, or
Well,
is that an issue?
yeah,
Not is it not an issue?
China's not taking any more.
Uh-huh.
They've been up again. I'm using some IEA numbers here, but they've been taking, I don't know, like 1.8 million barrels a day to 2 million barrels a day. But the thing with China, and this is why they won't be taking any more, is that they really want to diversify supply. That's one of their number one uh, tenets on their import mix, is they don't want to become too heavily reliant on any one supplier. Which I think is a lesson that Germany could have taken from the Chinese. So they're not going to take any more. Turkey, yeah, I also wonder. They're up to 1 million barrels a day, and I don't know if they're going to be taking any more either.
Yeah, it
Um,
certainly adds a little more uncertainty into the into the market.
yeah, yeah, definitely. Oh, no question. And I think, like the point you were making. Yeah, the one thing there probably will be is a lot of dislocation, and sometimes and dislocation can be very bullish for markets, particularly on the structure. Interestingly, though, the structure's really like collapsed. I mean, you look at WTI, the front to backs are trading in, the first M1 minus M2 is like in the 30s or 40 cents,
Mhm.
relative to $2-3 earlier. And even Brent is down only 60 to 70 cents. So, for now, the market seems pretty well supplied based on what's happened to the curve.
So I guess China demand, let's say the lockdowns stop, there's pent up demand. Is that enough to pull this market out of the doldrums?
Yeah, it could. I'm sure there'll be, prior to December 5th, maybe there'll be some demand surge, maybe. And, as I said, as we head into December, we're, you know, we'll see what, there's going to be dislocation post embargo. So maybe that'll help lift the market as well.
Yeah, I mean, I'm looking at the market now. We're down about $3 today, so I'm trying, and I know our podcast is supposed to be good for like a month, but I don't want to get
I
sound.
know. In the monthly, which I wrote last week, late last week, I'm thinking, all right, what I think is going to happen is that the trading range is going to lowered, right? We've been in
Right.
an 85-95 trading range recently, an 85-97. And I think, all right, we have this embargo coming up. I think it'll be lowered by a few dollars, maybe like 82 to 94 or 5 if things get, a little out of control with the embargo or anything else. We're Well, we broke 85, and
Yeah.
the market just doesn't look that we could get there right away.
Yeah, it's interesting. I mean, in your monthly, you said you had a bearish bias for crude oil, so I'll give you credit for that. It's also seems like there's a lot less volume going on, and open interest is down, and because of this uncertainty everywhere, it seems like a lot of people have backed out. Or maybe everybody went on holiday for August, but we'll have to see if we start seeing open interest build going forward. Oil markets really seem to get agitated in bear markets when you get these big moves down. Obviously, they get agitated when a war occurs as well. But I'm saying in general, the markets get really crazy. Volatility explodes on the way down. Just one thing that I'll bring this in. Speaking of options, we this is a market that has been clearly, if you looked at the option paper, I know for every buyer there's a seller, but the initiators of trades seems to be on the bullish side, and option volume has been low. But you see these blocks of trades, these gigantic trades, 20,000 lots at a clip, where I don't know if it's the same person. It sounds like it wouldn't be a very popular strategy, but they're buying these $1 wide call spreads. So in December of 22, just a couple of days ago, 20,000, 124, 125 call spreads went. If you look at the major open interest, it's in the 129, 130 call spread. There's like 50,000 of each. DEES 149, 150s, they're in the top 10. Our old favorite, the DEES 100, still has 43,000 open interest. And then you see a little chunk on the DEES 200 call and the DEES 250 call. So my point is there's this still this bullish sort of long term. Yeah, we're low now, but next quarter, we're gonna be well over $100, which could happen. But
Yeah,
yeah, no, it's a crazy market.
definitely.
But
Yeah.
on the put side, what's missing in this, if you think that the futures market sends us to an area where roughly it's 50% chance of going higher, 50% chance of going lower. What was missing is the sort of the downside put buying, and I'm not sure. I don't think anybody's doing that spec trade, and there's probably less hedging going on by buying those puts, and maybe that's what it is. Because when you look at the top 10 open interest in puts, it's still like the D60 put, the D50 put, the D40 put, and it's only about 20,000 lots, and these things were done, maybe over a year ago. So it's kind of like where is that part of the market? And maybe I guess when we do see it, it'll be time to buy. When we see the put buying coming out in big size, it'll be time to go the other way. But we just
Yeah,
haven't seen
usually
that. And that
that's one of your contrary indicators.
Yes, you're right. It's a contrary indicator sometimes. But the other kind of crazy thing going on that I posted in LinkedIn today, that's not, I wouldn't say it's real news if you're following the nat gas market, but the Feb implied volatility is hovering around 100%. So you're talking about an option that's 5 months out. It's not the front month that's 100%. It's the 5 month out. And obviously, it's seasonality, the winter stuff, but that's a huge number out there. And if I take that a little further, if you look at the skew, so we take a 25 delta, 0.25 delta on a put and a call, subtract the implied volatility, and in natural gas for October, the call is 8 vol points over the put, and for February it's 25 vol points over the put. So those are big numbers. Now for crude, the skew, except in these warlike instances, is usually a negative skew where the put's over the call, and that's what we're in now. So for October, it's -5, and for February, it's -7. So that's kind of a more normal looking market than natural gas. So I mean, we're not covering natural gas, but I just want to point out how crazy these energy markets are all around.
Well, I think the one that's been completely out of control has been the Dutch TTF futures.
Oh yeah,
Uh,
yeah.
They traded over the equivalent of over $100 per MMBTU either early last week or the week before last, and now they're back down to like 60.
Well, I was going to say, Andy,
So
unlike the Dutch tulip bulb rally, this rally had some really fundamentals behind it.
yeah, no question, but it does look, and of course natural gas, the European natural gas price is real. It definitely has an impact on on the petroleum markets, and that there could be some fuel substitution. There definitely was some fuel substitution, direct burning of crude and some residual fuel burning instead of natural gas. I think the IEA was saying it. They think it's 400,000 or 500,000 barrels a day increase in demand. I don't know if it's that high, but nevertheless, we'll see as we head into the winter. Exactly what that number is going to be, and yeah, that's an increase in demand. But I think the economic effect is probably going to be greater than what that increase is. Again, depending on the weather. But I think, Jim, that Dutch TTF futures, that has to be. I did look at one point. It looked like the vols were like 170% or something like
Yeah,
that.
you're right. I mean, there's no option sellers left. I mean, you can't. I mean, it's just I wouldn't say it's a broken market, but it's you can't. I mean, if you're a risk manager, you can't sell it, right? Can't sell vol. Be crazy.
No,
But
you can't sell vol. And
yeah,
if you're a risk manager in that market, your hair has probably gone gray very quickly, and I'm
yes,
sure your sleep is I'm sure your sleep is down to zero along, traders probably the same thing. I mean, the press has been pointing out that a lot of the European governments are going to have to subsidize the utilities just to make their margin calls.
right.
Um,
Yeah, it's been a
just think-
story around. Yep, that's an interesting risk management issue because we have Andy, you and I have talked to pure producers who will hedge, say, 10% of their production, and the market will run up, and they want to hedge another 10%. And some banks will say, you know what, we can't give you the credit for margin money. And even though with a higher price, they're a better credit risk, right? So if you're, it's a conundrum, but the banks can't keep. You almost need the central bank to get in there as a lender of last resort because it's a mismatch of cash flows between time periods or not because maybe you're not going to charge retail these customers these crazy prices. The middle class and the poor people can't afford it. It's just crazy. But yeah, we'll see how this. The other thing you don't want to do in Europe, Andy, is quote the Game of Thrones quote that's been used a lot. Winter is coming. That's just not funny anymore.
Oh man.
Yeah, if you're a risk manager, if you're your own personal risk manager, don't do that. But so let's get back to oil for a second. One of the worst acronyms of all time, the JCPA, the Joint was a Comprehensive Plan of Action. I mean, is
Yeah,
that
JCPOA.
JCPOA? Sorry, JCPOA. That's got to be such bureaucratese. What's the chances of Iran bringing something back onto the market in the next
Well,
6
I
months?
think the market is, it's not, we're in September, so I think for the balance of 2022, the chances are probably zero. And as we move into 2023, I don't think they're very high. However, in past negotiations at the very, as they're closing the door for good, the Iranians have come back with, something, something substantive actually to maybe clinch a deal. Now, right now, what they've come back with, the U.S. the U.S. and the other signatories to the deal have rejected it out of hand. So right now they're nowhere, and these negotiations continue to move in circles. But as I said, past behavior is any indication of future. There is a chance at the 11th hour that the Iranians come back. So I wouldn't put it at zero, Jim, but
Right.
I wouldn't put it at really high. I
Yeah.
wouldn't put it at like over, you know, 30%, 20%.
What about leakage? Is that growing?
Well, they've been pretty. Their production has been pretty steady. They caught a break on heavy fuel exports to Saudi Arabia because the Saudis decided, instead of doing, because crude was so expensive, they decided that instead of doing their usual direct crude burn that they do every summer, that they were gonna use residual fuel as to help them produce power for air conditioning in the summer, and most of that marginal residual fuel came from Iran. But there has been leakage, but it hasn't been like they've been able to increase a significant amount. Maybe 100,000 barrels a day here, or 200 here. And as I said, I think the summer they did pretty well because of the Saudis. Ironically, how
Yeah.
ironic is that?
Yeah. It's interesting. I mean, if you want a lot of pressure gets put on some maybe not such friendly regimes. If you have really low oil prices, you would think that you could you could do a lot more by getting Iran barrels back onto the market. Maybe a don't ask, don't tell type of policy. Same for Venezuela. Just maybe get these guys, get prices down and putting pressure on all the people that have not, let's just say, have not cooperated. You certainly put pressure on Russia as opposed to doing all this embargo stuff. It's not going to happen, obviously. And
Yeah,
there's
it's not politically, it's just not
no,
palatable.
no.
Um, one
Let's
thing that
yeah,
one thing that they could do actually is try to find a long-lasting solution to Libya, because
right,
there's something that is not a political. I don't think, at least in the U.S. That's not a big political. There's no big political agenda, I don't think, for Libya.
right,
So, it would be nice if Libya, which is essentially the marginal producer now, if Libya could become a reliable exporter rather than an unreliable exporter.
right,
And, recently there were clashes in both Libya and Iraq. There
right.
were clashes, and the market really worried about it. And, for good reason.
Of course. Yeah, Iraq is doing a good job pumping oil, that's for sure.
Yeah.
But they're around 4.6, something like that.
Yeah, yeah, they've got, they have some spare capacity, not a whole lot. I mean, that's the other bullish factor, is there's not a tremendous amount of spare capacity in the world. And Saudi has some, but you know, they're they're up to, they're close to 11 million barrels a day. We'll see if they're able to produce at that, and maybe they've got a million and a half spare, and UAE has some spare capacity. So, that has in the past been a very, really bullish factor as we start sucking up any spare capacity.
Andy, can we talk about cracks for a minute?
Yeah, cracks have been unbelievably interesting,
Yeah, I thought you were going to say,
particularly the diesel crack.
yeah, go ahead. Start with diesel.
I mean, the diesel crack, holy moly! I mean, diesel crack went to, like, over $70.
Right,
It's still at like $62. These are great numbers, and obviously, given where the numbers are, any refiner, if they could, would produce as much diesel as as possible. But they can't. Not that we're not at the point where we've been able to build the diesel stocks. We're in diesel is, last week's numbers were like 112 for total distillates, 112 million, and it should be for this time of year around 145 million.
Mm,
And this is why the crack is out of control. Most of the shortfall is here. It's in New England and Central Atlantic.
yeah.
And where do we use heating oil? New England and Central Atlantic. So, we're in, we're not going to make it, I don't think, to build to anything to build anywhere near what we need up here. Now, certainly heating oil demand has gone way down over the last couple of decades, but still, there's still heating oil users, we don't have it. So, and we're going into turnaround. So I'm not, I think we'll see a modest build over the next couple of months, but those cracks may just come off because they're at 72, 62. But I don't see them collapsing unless the diesel yields really start pumping it up into the mid 30s, which they won't.
So, so
Um,
you mentioned earlier that we're exporting a lot of diesel. So you're saying it's from the Gulf. It's not coming up to the Northeast, Andy?
Well, Jim, there is something that you and I have talked about for a long time, and that is the Jones Act.
Right,
Maybe if there's any kind of, maybe if we get one of those ridiculous 1989 winters,
right.
um, you remember, I'm sure you remember,
Yep.
if we get one of those, maybe we could do something about getting rid of the Jones Act, where basically you can only transport U.S. produced products through U.S. ships, and it makes the production of it makes the transport or the distribution of U.S. products really expensive by ship.
You brought up 1989. I'll just make this quick, but that was the first year I gave out the Option Trade of the Year award. One of our favorite customers came into our office and said, I'm bullish on the heating oil season. I want to buy calls. What's the most bullish thing I can do? And so I gave him a trade where you sell an at the money or a little bit out of the money. You take that money and you buy a whole bunch of out of the money calls. And he said, that's too complicated. I said, okay, find the highest strike price you can and buy a whole bunch of them, which he did. And the market went up so much, they went in the money and he sold them out and he did it again. He bought a bunch of deep outs and the market went up again to that level and he did it again and the market went up again. He made, the risk, he made millions on just a few dollars, basically. It was one of the greatest trades I've ever seen. Anyway, let's get back to it. So,
Well,
so
anyway, let
yeah.
me tell you something. If we get something where, like this pipeline issues, and it's free, that
Oh
winter,
yeah.
everything that could have possibly gone wrong went wrong. The refineries went down in the Gulf Coast because it was freezing, and then we had pipelines got messed up, and then it was
Yes.
freezing up here, right? I
Yes.
mean, it was one thing after another,
Right.
and stocks are so low up here that something like that, demand is way less than it was 25 years ago. But wow, Jim,
Yeah.
that was 33 years ago.
Yeah. That was a long time
Oh
ago.
man.
Uh, uh, Refining, you mentioned turnarounds. Are these refiners running really hard, or is this like business as usual? Are they going to basically the turnarounds are the scheduled maintenance that refiners go through starting in September, deep
Right,
into October.
right.
What's your thought there? How much is going to be taken out for maintenance?
Well, it should be if I'd say an average. It looks like it's going to be an average type turnaround season, but at any one point over the next couple of months, there's going to be, I shouldn't say at any one point, at points, there's going to be, well over 1 million barrels a day down. Maybe the average is a lot less than that. So, it's a pretty good turnaround season. The other thing, we're headed, it's September, October, it's hurricane season. there haven't been any hurricanes. There's like one named storm, two named storms, and it hasn't even come close to the Gulf Coast. But as we learned as we've learned in the past, it only takes one big storm. So that's another thing to look at. Last point I want to make on the cracks is that the gasoline crack has really come off hard, basically because the demand has been, horrendous. Not horrendous, but it's really been disappointing in July and August. And inventories are now, in terms of a day supply, are are like a half day above the 5-year average. Cracks went down to $12
Mm.
at one point from like the 40s or 40s or 50s earlier in the spring and summer. I think gasoline's a little oversold here. I still have a hard time believing that demand is as bad as what the weeklies are saying. But if that's true, if it and they'll be revised 2 months from now, so we're not going to find out until 2 months from now. But in any event, demand it really isn't that bad. I think gasoline is way oversold, and it could, I think we could see a little bit of a recovery, and the cracks have recovered some. I think they're
Andy,
like 16.
before we go, because we're up against the time limit here, can you just mention how someone might be able to subscribe to your monthly? Because you have a lot of good, you and Ed have a lot of good stuff in there, and maybe some of our listeners would be interested in getting it on a regular basis.
Yeah, you can subscribe by getting a hold of me at Lebow at commodityresearchgroup.com. You can also go to our website, commodityresearchgroup.com. And, if you're interested, Ed does an amazing job with metals. I try to do as good as I can on oil, and we've got some other products there. And it's a really good summary of what's going on in the market and what we're looking for over the next couple of months. And Ed is, he's always named number one. Ed Meir is always named number one in base metals analysts, one, two, or three by Fast Markets, which is the old metal bulletin. And you can reach out to me on LinkedIn, Andrew Lebow, Lebow.
Beautiful. Anything else you want to add to the podcast today, Andy?
No, there was a lot of material to cover.
Yeah, we bounce
So
around. I'm sorry about the going from back, but that's kind of market it is, I think. You supply demand cross at some point. If you're talking about, you know, demand, you're talking about high prices. If you're talking about high prices, you're talking about supply. So it's, yeah, but good job, Andy.
there's a
We'll
lot
pick
to
this.
unpack. There's more than usual, and it's usually a lot to the suitcase is usually pretty full
It
in
is some,
in
yeah,
in oil. This time it's like you got to pay extra to get it on the plane.
exactly. You check the bag. Okay, thanks, Andy. We'll pick this up
All right,
next month.
thanks, Jim.
Okay, bye bye.